Nike is one of the most recognized consumer brands on earth. It's dominated athletic footwear and apparel for decades. And in 2026, its stock is trading at 44.14, and that's significantly below where it stood at its peak. The reason is a combination of structural competitive pressure, a difficult China market, shifting consumer preferences, and a strategic reset that has not yet produced visible results. And at the center of the competitive threat is a new wave of Chinese athletic brands that are, according to G1, a major Chinese sportswear company is openly targeting Nike and Adidas with products that combine competitive performance with dramatically lower price points. This is not a fringe competitive threat. It is a structural challenge to one of the most profitable brand modes in consumer goods. Chinese sportswear brands including Anta, Li Ning, and Xtep have been investing heavily in product development, athlete sponsorships, and retail expansion. They are not simply copying Western designs at lower prices. They're developing genuine athletic performance credentials while maintaining significant cost advantages from domestic supply chains. For Nike specifically, the China market represents a major strategic challenge on two fronts. First, Chinese consumers, who have been among the most aspirational purchasers of Western luxury and premium brands, are increasingly receptive to domestic brands that offer comparable quality. Now, second, Chinese competitors are not limiting their ambition to the domestic market. They're expanding internationally, with particular focus on Southeast Asia and Latin America. This dynamic creates a classic brand squeeze. Competitive pressure from below on price and from emerging premium domestic brands above. Managing both simultaneously while maintaining the revenue growth expectations priced into Nike's valuation is genuinely difficult. Nike's strategic response has involved several elements. The company has pulled back from some wholesale channel relationships to focus on direct-to-consumer sales, which carry better margins. It has invested in digital platforms and membership programs designed to strengthen customer loyalty and data advantages. However, these strategic shifts take time to produce results, and in the transition period, revenue and margins face pressure. When a company with Nike's market position and margin expectations reports revenue weakness or guidance reduction, the stock can fall significantly because the base valuation assumed continuation of the previous trajectory. For CFD traders, this creates a specific opportunity set. Nike's stock is sensitive to several distinct catalysts: quarterly earnings results against consensus expectations, any news about China market conditions, and signals about competitive dynamics from companies like Anta that report their own results. Nike's challenges are part of a broader pattern in consumer staples and discretionary sectors. Companies that built dominant market positions over decades are facing new competitive dynamics driven by Chinese manufacturing capability, platform-based distribution that reduces the advantage of traditional retail relationships, and changing consumer behavior that makes brand loyalty harder to maintain. Starbucks, which also appears in recent market news with its stock at 104.93, faces a related challenge in China, where local coffee chains have expanded aggressively with lower prices and strong local market knowledge. The pattern across premium Western consumer brands is remarkably similar. For traders monitoring the consumer sector, the most useful analytical discipline is tracking not just the brand's home market performance, but its China exposure and the competitive dynamics from domestic Chinese challengers in each category. Nike at current levels presents a classic value versus value trap question. The stock is significantly below its highs, trading at multiples that look more reasonable than they did at the peak. But the key question is whether earnings estimates have fully adjusted to reflect the structural competitive changes underway. If competitive pressure continues to intensify and the strategic reset fails to accelerate revenue growth, current estimates may still be too optimistic, meaning the stock could remain under pressure even at lower multiples. If the strategic reset begins to show results, with direct-to-consumer growth accelerating and China market stabilization, the combination of a lower starting multiple and improving fundamentals could produce a strong recovery. The catalyst to watch most closely is the China market data. Any sign of stabilization or recovery in Nike's China revenue would likely be treated as a significant positive by the market, given how much concern has been priced in. Nike under pressure is not simply a story about one company. It's a case study in what happens when a premium consumer brand with a decades-long competitive moat faces a genuinely new competitive dynamic from a geography with structural cost and scale advantages. The same pattern is playing out across automotive, technology hardware, and other consumer categories. Understanding how to identify where these dynamics are in their cycle and how to position when competitive disruption is being priced in versus when recovery is beginning is one of the most valuable analytical skills for any market participant. What's your view on Nike's competitive position? Drop in the comments below. Guys, we read everything. See you in the next video.